Hey everyone, welcome back to Corporate Decoder. Today, SLSN just filed an 8K, and I am seeing a major accounting issue that means we can no longer trust their past numbers. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is basically saying that their old financial reports are wrong and need to be redone because of big mistakes in how they counted inventory costs. So what we have here is a current report filed by SLSN Inc, a company in the consumer defensive household and personal product sector. They have a market cap of about $67 million and around 115 employees. This filing is an 8K, which is used to announce major events that shareholders should know about. In this case, the big news is item 4.02, which basically means they are saying, don't trust our old financial statements anymore. The filing date is the 21st of August 2026, but the earliest event reported happened on the 17th of August 2026. This is the date when the company's audit committee, board of directors, and top executives decided that their past financial reports were no longer reliable. The company says that while they were getting ready for their second quarter report for 2026, they found problems with how they were accounting for inventory. This is not entirely new news, as they had previously mentioned an inventory costing error and a delay in filing their Q2 2026 report around mid-August. So the market might have had some heads up, but this filing confirms the seriousness of the issue. So what exactly was the problem? They were using budget numbers to figure out how much labor and overhead costs to add to their inventory. But these budget numbers weren't solid enough. They also weren't properly tracking which costs should be included in inventory, how to handle costs that change with production levels, or making sure their planned costs match the actual costs. This is a pretty fundamental accounting error when it comes to valuing inventory. Think of it like trying to price a cake recipe, but you are just guessing how much flour and sugar you are using instead of actually measuring it. Because of these mistakes, their inventory was reported as being worth more than it actually was. This also means that the cost of making their products was wrong, which in turn messed up their gross profit, operating income, and ultimately their net income or loss. Basically, almost every key financial metric they reported was likely inaccurate. This kind of error can cascade through all their financial statements. This statement is the heart of the filing. They are saying that all their financial reports from the end of 2023 all the way up to the first quarter of 2026 are unreliable. That's a lot of financial history that needs to be revised. This is a pretty significant issue, and it means investors will have to wait for corrected financial statements to get an accurate picture of the company's performance over this period. This is similar to what happened with many companies during the dot-com bubble, where accounting improprieties came to light, forcing restatements and eroding investor trust. They plan to file amended reports to fix these numbers in the coming weeks. This means more paperwork and a delay in getting a clear financial view. Investors will be watching closely to see how large the adjustments are and what they mean for the company's financial health. Given the number of affected periods, this restatement could be quite substantial. It is important to note that the company has discussed these issues with their independent auditors. This suggests that the auditors are aware of the problem and will be involved in the restatement process. The filing also includes Exhibit 104, which is the cover page data in a format that computers can easily read, called inline XBRL. This is standard for SEC filings and helps with data analysis. The report is signed by Laura Riffner, the Chief Financial Officer. As the CFO, she is ultimately responsible for the accuracy of the company's financial statements. So her signature here is significant. Looking at the broader context, SLSN has had a rough time lately. We've seen headlines about revenue falling significantly and net losses in their recent Q2 earnings. There have also been reports of shipment delays and high operating costs. This inventory accounting issue, combined with these other challenges, paints a picture of a company struggling with its operations and financial reporting. The fact that their stock price has been volatile, even seeing a bump on the 21st of August despite this news, is interesting and might suggest some market players are looking past the accounting issues for now, or perhaps the news of the delay was already priced in. When a company has to restate its financials like this, it raises serious questions about internal controls and management oversight. It is not just about correcting numbers, it is about rebuilding trust. For investors, this is a major red flag. It's hard to make informed decisions when the past financial data isn't reliable. For a small company like SLSN with a market cap of around $67 million, a significant restatement can have a much bigger impact than for a large corporation. It can affect their ability to secure financing, their relationships with suppliers and customers, and their overall valuation. We've seen historical examples, like with Sears, where multiple accounting issues and restatements preceded a company's eventual downfall, while SLSN isn't Sears. The pattern of uncovering fundamental accounting flaws is concerning. The real impact will depend on how large the adjustments are. If the overstatement of inventory and understatement of costs are significant, it could mean the company has been less profitable or even less solvent than previously thought. The biggest risk here is the loss of investor confidence. When a company can't even get its basic accounting right for several years, it makes you wonder what else might be wrong. The path forward for SLSN will involve a lot of hard work to correct the errors, refile their reports accurately, and then convince investors that they have fixed their internal processes. This is a long and often painful road. What I am watching for next is the actual magnitude of the restated numbers and how management communicates the plan to regain trust and improve their accounting procedures. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like, subscribe, and join our Discord community.